Hey everyone, welcome to this explainer of the latest economic data. We're going to dive right in today because, well, we've got this massive contradiction sitting right at the center of the recent July jobs report. We are looking at data that seems completely at odds with how the financial world actually reacted to it. It's a real puzzle of macroeconomic proportions. So let's figure out what this data is actually telling us, and more importantly, what it might be hiding. To really grasp the scale of what we're looking at, you have to look at what was supposed to happen. The market was fully expecting the US to add about 83,000 jobs in July. But the reality? It missed that mark completely. The official data showed a loss of 23,000 jobs. That's not just a tiny rounding error, right? That is a total 180 from growth straight into contraction. Now, by all conventional logic, losing jobs is terrible news for Main Street. You'd think Wall Street would be in full panic mode, but they weren't. Instead, the stock market practically threw a parade over this disastrous report. So you've got to wonder, how on earth does bad news for the everyday worker turn into a massive celebration for investors? Well, that is exactly the mystery we're going to solve today. So here is our roadmap for how we're going to piece this puzzle together using the source material. First, we'll look at the jobs paradox, then real unemployment, followed by wages versus inflation, AI job cuts, and finally, what the Fed's next move might be. Let's get to it. Starting off with Section 1, the jobs paradox, and peeling back those revisions. So when you actually look under the hood here, the government quietly revised the May and June figures downward by a combined 103,000 jobs. Basically, the market was already softening before July even hit. But the source material we're analyzing today takes it a step further. They argued the true state of July's labor market is actually much worse, estimating the real job losses are closer to 100,000. And they make a pretty compelling point that the lived reality for most Americans aligns a lot closer with that bigger number. Moving on to Section 2. The real unemployment story, and how job losses somehow lower unemployment. Now, we literally just established that the economy lost thousands of jobs in July. But wait for it, the official unemployment rate actually fell from 4.2% in June down to 4.1% in July. Wait, what? How can the unemployment rate possibly go down when the labor market is actively shrinking? It honestly sounds like impossible math. Well, the secret to this little mathematical magic trick comes down to one crucial metric: the labor force participation rate. See, the government only calculates unemployment based on people who are either currently working or actively looking for a job. If you aren't out there actively searching, you just don't exist in their calculation. Let's think about how this actually plays out in the real world. Say a person loses their job and starts actively searching for a new one, but the market is brutal and eventually they just give up out of sheer frustration. Well, because they stopped looking, the government removes them from the workforce data entirely. The crazy result? The official unemployment rate actually drops. The author of our source report points out that this practice is incredibly misleading because those frustrated, discouraged workers, they are absolutely still unemployed. Of course, the job market isn't shrinking everywhere all at once. It's a bit of a mixed bag. Sectors like healthcare, construction, and professional services are actually the ones propping the whole thing up right now. But on the flip side, the real bleeding is happening in government, financial activities, retail, and leisure, with government roles actually taking the absolute biggest hit. All right, that brings us to Section 3, wages versus inflation, or what we like to call the hidden pay cut. This is where things get really tight for the average person. Over the past 5 years, wage growth has definitely slowed down, landing at just 3.2% in July. Meanwhile, the official June inflation rate was sitting higher at 3.5%. But here's an interesting twist. The analysis we're following presents a much more controversial view. They argue that the official inflation rate is essentially doctored, and that true inflation tracks way closer to the growth of the money supply, which is currently expanding at around 6%. Now, whether you go by the government's 3.5% or the source's 6% estimate, the math shakes out the exact same way. Because the cost of living is growing faster than that 3.2% wage growth, the average American is effectively taking a massive hidden pay cut. It's that simple. Your expenses are just rising faster than your paycheck is. Next up, Section 4, AI and tech job cuts, specifically looking at the Challenger report. 149,023. Let that number sink in for a second. That is the massive number of tech job cuts recorded so far this year alone. Tech is absolutely leading the charge when it comes to downsizing right now, but honestly, it's the specific reason behind these cuts that is really shaping the future of work. And that reason? Artificial intelligence. AI was actually the #1 cited reason for job cuts, making up a full third of all tech layoffs in July. And what's truly staggering here is that AI has been the leading cause of job cuts for 5 consecutive months now. Our source material points out this wild irony. Even though AI is, frankly, very unprofitable in a lot of situations right now, it's still the shiny new toy attracting all the investor money, even as it actively displaces human workers. Okay, finally, Section 5, the Fed's next move. It's time to solve our stock market paradox. So the answer to our mystery from the beginning, it all comes down to the Federal Reserve and interest rates. See, before this disastrous jobs report dropped, the market believed there was a solid 67% chance the Fed would raise interest rates in September. But the exact second that weak labor data hit, that expectation plummeted down to 51.7%. So now the market is completely split. It's basically a coin toss on whether they raise rates or just do nothing at all. And this right here is exactly why Wall Street was cheering for a bad jobs report. A struggling labor market creates a huge disincentive for the Fed to raise those interest rates. Let's tie this whole thing together. The Federal Reserve operates on a dual mandate: keep inflation under control and maximize employment. So when employment data comes in weak, it heavily pressures the Fed to ease up. And Wall Street, well, they absolutely thrive on cheap money. Bad news for the everyday economy means lower interest rates, which fuels a booming stock market. Plus, the report we're looking at wagers that, despite some predictions, the Fed will probably just maintain current rates anyway, not just because of the economic data, but because of heavy political pressure and a lack of true independence. So, we've dug into the official data, those quiet downward revisions, the mathematical loopholes, and the very real shifts being driven by AI. But, macroeconomic stats really only tell one side of the story. The analysis ends by turning the focus back to the everyday worker. And I want to leave you with that exact same thought. Look past the official numbers and Wall Street's big party. If you are actively out there looking for a job right now, what is the labor market really like for you?